Okay, I think we should start. Good afternoon. My name is Brian McGann. I'm the head of investment strategy here at Beacon Trust. I'd like to welcome you to our year ahead 2025 market outlook. I know it's January 23rd, but we have a lot to discuss. Lots gone on. We had a very eventful 2024, and we expect a lot out of 2025. And with me today, as usual, our Chief Investment Officer, Dr. John Longo, also distinguished professor at the University of Rutgers, Rutgers University Business School. So again, I'll just go through a couple of logistics for the webinar and then kick it off. John's got a lot of material to cover, and then we'll handle some Q&A generally at the end. So for right now, everybody's on listen-only mode. If you do have questions, there's two buttons on the bottom of the screen, the Q&A box, or the chat function. I'd encourage you to use both, or one or the other for questions as they come up. And like I said, we'll address all of those or most of them at the end. And if we have an overflow of questions, hopefully that would be a good problem for us to have. We'll reach out to the team and make sure those questions get addressed shortly after the call. So without any further ado, let me hand the conversation over to John.
Thank you, Brian. Welcome, everybody. This is always my favorite webinar. We kind of get to look back and look ahead. And it was really a great year for most asset prices. So let's recap what happened in 2024. Certainly the star of the show is large caps, really for the past 2 years in a row. The S&P was up 25% last year. It's 2 years in a row it was up more than 20%. Clearly, big tech stocks did incredibly well. So those are often reflected in a growth index. You can see the Russell 1000 growth was up 33% last year. Value stocks, not quite as well, but not bad, 14%. And smaller firms lag. They're represented by the Russell 2000 index. If you look around the globe, MSCI stands for Morgan Stanley Capital International. That includes US as well as rest of the world, up 18%. But emerging markets, you probably saw some headlines from China, not quite as well. But a lot of green on the screen here. Bonds, sort of subdued year. Near the end of the year, they were up almost 4 or 5%, but interest rates spiked. We can chat about that a little bit. And the common benchmark for fixed income, the Barclays Agg, was up 1.3%. It was also a stellar year for gold. I know inflation is going to be one of our themes today. Gold was up 27%. And then looking at some alternative investments, hedge funds up 12%, REITs, which is real estate, up 8%, and a broader commodity index up 5%. I mentioned it was a tremendous year for big tech. If you follow the financial media, you've heard the name Magnificent Seven. For those that don't follow the financial media, Magnificent Seven is 7 large tech stocks, specifically Microsoft, Amazon, Google, NVIDIA, Facebook, Apple, and Tesla. Those stocks you can see here, excluding dividends, were up 24+% in both 2023 and 2024. Now, that's 7 out of 500 stocks in the S&P. If you look at the other 493 stocks, they were up on average low single digits. So this does help explain the divergence in performance, especially if maybe some clients had some value investments or international investments. And, we like these names, we own these names, but we're expecting more subdued performance, which I'll drill down on as our webinar unfolds. Now, we're going to talk about our outlook for 2025, but it makes sense. Brian mentioned I'm a professor. Professors give grades. I should grade myself here as well, our entire Beacon team. And before I look at 2023, our best year ever was 2023. We had 9 out of 10. But last year, out of our 10 predictions, 7 were correct. So I'll briefly go over these and then move on to 2025. We thought stocks would have a pretty good year, specifically about half that of 2023. So overshot the mark a little bit, but still we'll put that in the win column. Bonds we also thought would deliver low single-digit returns, barely squeaked into that positive territory. We hit this one on the nose that we thought the Fed would cut rates 3 times, and they did indeed 3 times for 1%. We thought inflation would fall, but still remain above 2%, which I think will be another one of our themes this year. CPI went from 3.4% to 2.7%. Here's one of our misses. As we saw on the prior slide, small cap did about half what large cap did. Maybe that will reverse this year. Let's see what happens. We thought it'd be a good year for earnings growth, and that was correct. The earnings this year increased about 10%, more than the historical average of about 8%. Unemployment, you might remember coming to this year, was at a pretty low rate, a little bit less than 4%. We thought it would increase. It did tick up to 4.2%. Another one of our misses is that we thought the dollar would weaken. Partially is because the Fed didn't cut rates as aggressively as some expected. So a dollar weighted index called DXY actually increased 7% last year. Pretty good if you're traveling to Europe on vacation. We also tracked the consumer pretty closely. We thought consumer sentiment would increase, and it did indeed increase 6%. We also had a series of elections that I'm sure we'll chat about in the call. We thought it'd be a mixed bag, but now the results are in. The Republicans swept all 3 races. So let's put 2024 in the rearview mirror and look ahead to 2025. So here's our 10 forecasts, and then we'll collate them into 4 themes. One, of course, what are we thinking about the stock market? Well, let's call it a decent year, but not great. Specifically, I'll give you a number on it. We're expecting more subdued returns. So if you're asking me for a number or range of numbers, 8 to 12%. How do I get there? Well, let's look at this picture here. So we have this thing called the PE ratio, which sort of measures the value of a stock versus its earnings, kind of like a yardstick for how expensive is the stock market. And what you can see here is coming into the year where the PE of the market was 21.5. Now, arguably, the market can probably support sustainably a PE of 20. Now, part of the reason is that we have these Magnificent Seven stocks, and they are magnificent in many respects. They have higher profit margins, stronger balance sheets. Think about an Apple, think about a Microsoft. So how we're going to get to our 8 to 12% forecast is that we're going to assume that the PE multiple for the market as a whole contracts a little bit, but we also add earnings growth on top of that. So if we go from a PE of 21.5 to 20, that's a 6% drop. But last I checked, consensus earnings were expected to increase 15% this year, led by financials and technology. So when you put that together, you're getting like 8-ish%. And then if indeed we get some tax cuts, that could also potentially boost profitability. So bottom line, if we get half of what we got last year, we'd be pleased with it. Now, this is kind of drilling down, and we sometimes call it a market of stocks, not a stock market. And we have NASDAQ over here. So the red bar is the 10-year average. And then obviously the top of the bar is where we are currently. So what this shows, and a little bit like I showed on the prior screen, some stocks are a little bit on the expensive side. Wouldn't make us panic, but they're a little bit expensive. So the question is, where might be there a little bit better value? Well, as I discussed in the 2024 recap, if you see areas that lagged a little bit, you might actually get multiple expansion as well as the earnings growth. So sort of a summary of this is that, yes, the market is on the expensive side. That's the bad news. But the good news is we have growth. The good news is we have some pro-business regulation coming, and we have innovation, which is one of our themes. So we're still largely invested in the market in most diversified portfolios. Let's talk about bonds. So there's a lot going on here. Bonds we view as kind of ballast for the portfolio. And you might remember back in 2022, it was perhaps the worst year ever for bonds, certainly since the 1970s. The Barclays Ag Index went down 13%. So what this shows is that every single year, whether you're looking at stocks or bonds, there is a drawdown. So that's the red part of the graph. Last year, bonds top to bottom fell 4%, but as we saw, they ended the year at 1.2%. Now, let's look at this yield curve. So a yield curve is kind of the relationship between the time to maturity. So we have short-term treasury bills over here and then long-term treasury bonds over here, and yield to maturity. So why we have this curve up here is that when we talk about interest rates, it's not a single number, it's an entire range of numbers. And you can see the curve is flattish here. We're in the blue. And the good news is that we're starting at a decent level. Let's call it 4% and change. So now we get to our bond forecast. What we think is that bonds will do better than last year. 1.25% is not too hard to beat, but we'd be surprised if it can exceed mid-single digits. Specifically, our view is that the Fed is going to cut rates a little bit, 25 to 50 basis points this year, and then intermediate to short-term interest rates will drift up. So what is this graph showing? Well, this graph shows that not all bonds are created equal. Many of you interacted with my colleague, Susan Hayes, who runs our fixed income portfolios. And Susan does an excellent job, and we're in agreement that most of our client portfolios are going to be tilted towards short-term to intermediate, high-quality investments. And why that's relevant is that if interest rates spike, let's look at the 30-year here. If the interest rates go up 1% and you're owning a 30-year bond, even with the cushion, you could lose double digits. So we're going to be skewed over here. And the reason is that we can clip our coupons and we can withstand a small rise in interest rates. So, we have bonds as diversifiers, we have bonds for income, but we're not going to be in bonds to get double digits. So to kind of repeat what I said on the Fed, I saw the headlines today. President Trump is demanding the Fed cuts interest rates. Well, he can demand what he wants. The Fed is independent, at least with the current situation. So one of the ways we get to our interest rate forecast and Fed forecast is to look at futures prices, and that's what this graph is showing. And the current rate, sometimes they have a range. So the current rate is 4.25 to 4.5%. You can view that what you're getting in a treasury bill, maybe a little bit more in a money market fund. So there is a 14% chance the Fed does nothing, that is, keeps rates constant. But if you look over here, kind of the belly part of the curve, there's a 33% chance of one cut, 25 basis points. And then we have another 30% chance of would be 50 basis point cut. So we're going to stay over here and said the Fed is probably going to cut rates once or maybe twice. So good and bad news on that. It's not bad getting 4+% in a money market or treasury bill, but that yield is slowly going to vanish as we go through the course of the year and into next year. Well, inflation is always in the news, and this is the graph. You can see the numbers have ticked up. As you know, the Fed has explicitly said our target for inflation is 2%. I hope they get there, but I don't think it's going to happen. So there's a lot of things driving this. We can talk about tariffs. We can talk about potential impact of immigration. But let's face it, it's not going to be a disaster. At least I hope not. And just before the call, I was looking at historical inflation data. And in case you don't follow this, the Bureau of Labor Statistics tracks inflation. They started tracking inflation in 1913. Since 1913, inflation has averaged 3.7%. And yet the US economy has done just fine. So to me, once you start getting close to 4.5%, 5%, people panic. If it's 2.5 to 3.5, I think the economy can take that in stride. So to summarize, we think inflation is going to stay in this 2.5 to 3.5% range. We think the economy can handle it. And part of the reason is, the Fed is not going to be able to cut rates aggressively because of full employment, because of potentially tariffs and other things as well. Moving on to forecast 5. Well, we think financial securities, the financial markets, they're kind of in a good position. And this just shows a graph of IPOs. And you might remember in 2021, there was a lot going on. There were EV stocks, there were other technology stocks, there were crypto stocks. And then you can see IPOs fell off the cliff. So given the change in the administration, less financial regulation, we think that more IPOs will happen, and especially led by AI, which I know is going to be another one of our themes for the call. This is, to me, a comforting graph. Let's face it, we're very fortunate in this country in many respects. Certainly, those that have investment portfolios done quite well. And what this graph shows are companies that have been started from scratch within the past 50 years, many of them in the past 25 years, like Facebook or Amazon, that are worth more than 10 billion. So we look at the US over here on the left, and then we look at the EU, which you can barely see if you squint on the right. So when I kind of go through a rough period in the markets, I say, well, there are people working on innovation, whether it's quantum computing, whether it's AI, whether it's the electric vehicle, whether it's the personal computer, the smartphone. And this is kind of the secret sauce of the US, that we have tremendous innovation and we have capital markets, importantly, to bring these ideas to market. Well, we just had the inauguration, and a lot of things are said in the campaign trail that Brian and I will briefly chat about, and we look at what can be implemented. And one of President Trump's comments, he can end the war in one day. Well, we don't think it's going to happen in one day, but we do think that there is an incentive to get things done. Number one, President Trump made a campaign promise. Number two, Russia is dealing with very severe inflation. I mentioned we're dealing with inflation around 3%. In Russia, it's often 30%. Obviously, there's a terrible human tragedy going on there. We don't know what a settlement's going to look like, but one thing that's been potentially floated is a buffer zone in some of these contested areas. And let's just hope something gets worked out, but we think the seeds are in place towards at least some negotiations. Now, we periodically get questions, what would make us change our asset allocation more significantly? And the answer would be if we were entering a recession. We don't think that's the case. So just to recap some numbers from 2024, the Q4 numbers aren't quite in yet, but it looks like US GDP in 2024 grew at 2.5 to 3%. We think that number is going to be somewhere in the ballpark for 2025. But if you look under the hood, it is a little bit of a tale of two economies. We sometimes call this a K-shaped recovery, where most of the people that are on this call are probably in a fortunate situation. Your investment portfolio is probably doing pretty well. If you own a home, your real estate has probably gone up quite a bit. Unemployment rate's pretty low. So the upper end consumer, the higher end consumer is doing quite well, but the lower end consumer is still struggling with inflation. The cost of many things, food, insurance have gone up quite a bit. If you're not yet fortunate enough to own a home, it's an incredible barrier to entry, especially in this New York metro area. So we think it's going to be a decent year for the economy. Let's call it in the 2 to 3% area. And as I said, importantly, if we see no recession, we're going to kind of stick with our general diversified portfolio with always changes at the margin, but nothing more dramatic, like a dramatic cut in equities. We track the consumer because the consumer is 70% of GDP, and a lot of it's psychology. So we think consumer sentiment will continue to go up. What we have lately is what we call disinflation. We have inflation, but at lower rates. So gradually consumers get accustomed to paying, for example, $15 for a burger and fries as opposed to $5 to $10 a few years ago. They get accustomed to that price. Hopefully they're getting a rise in their paycheck. Not to mention we had a very contentious political season. So regardless of, the outcome, we're going to have to deal with it. So people are kind of getting on from these things that were causing a lot of stress. There's more clarity on policy. So we think consumer sentiment will increase, which is an important underpinning for the economy. Now, one of the things that makes us somewhat optimistic that inflation is not going to spiral out of control is we think the price of oil on average will come down versus last year. This is a price of oil over the course of 2024. You can see at various points it was over $100 a barrel. If I had to take an average of this with kind of a ruler, it'd be around $80 or so. So as you know, part of President Trump's platform is to encourage energy production. And energy, oil prices, it's really permeates the entire economy. Most of us are still using gasoline to power our cars, things like jet fuel, heating oil. Even if you order something on Amazon, there's logistics behind that. There's an Amazon truck delivering your package. So this is one of the things we think is going to keep a lid on inflation as opposed to getting into that 5% plus area. So we think the price of oil is going to come down on average versus 2024. Elon Musk seems to be everywhere. He's leading the Department of Government Efficiency, known as DOGE. And you might have heard that DOGE wants to cut $2 trillion from the federal budget. Well, first of all, Congress controls the purse strings, so Elon can't just take a scissor to it. But if you look at the chart and the little graph on the right, which I'll explain, we don't have $2 trillion to cut right away, right? So maybe 10 years from now, we can get to 2 trillion, but we think at best, and this might be stretching, 25% of that 2 trillion can be cut. So let's look here on the right. This is our spending. This is our revenue, mostly from taxes, and this is our deficit. Deficit's not good because it results in interest payment where money is basically just going up in smoke. So one of the best things we can do is to have a more balanced budget. Now, it's not going to happen anytime soon, but you may know that most states actually have a balanced budget. So, if I were running the Treasury, I'd say, let's have a balanced budget unless there's a severe type recession. Well, it's very difficult to cut kind of the budget in these mandatory programs, primarily Medicare and Social Security. So we have to look at discretionary. Somewhat surprisingly, defense is in discretionary. Maybe we can cut a little bit. So for example, President Trump's probably going to turn up the screws on our NATO allies and get them to contribute more. Maybe we can spend a little bit less. But make a long story short, there is not a lot of room to cut. And therefore, in addition, if we cut 2 trillion, that alone could push the economy into a recession. So one of our themes that a lot is said on the political trails, and let's actually see what gets implemented. But at the margin, we think there's some cut, but nothing close to the 2 trillion that is planned. All right, so what does that kind of all mean, those predictions, in terms of how we're creating portfolios here at Beacon? Well, number one, let's face it, we've had a really nice run in equities, up 25% roughly 2 years in a row. I'd love to be wrong and see another 20% rate of return. In case you're wondering, during the inflation of the internet bubble in the mid to late 1990s, we did have 3 years of 25% or 20% plus rates of return. What is more realistic is that you're going to get appreciation in line with earnings growth and maybe some valuation contraction, which gets us in, let's call it a 7 to 10% rate of return, which is really not that bad. So that's our outlook for both this year and if I had to look out the next 3 to 5 years. Two, as we said, we think inflation is going to remain stubbornly high above that 2% target. We call it the last mile, getting it from 3% to 2%. Well, what's driving that? Well, there's the wealth effect that I alluded to. The wealth effect is that if you're feeling wealthier, your stock portfolio going up, your real estate portfolio going up, having a job, well, you're spending more. Hopefully you're taking a good vacation or something like that. Tariffs in general, and we'll get into this in the Q&A, I think are inflationary at the margin. It's not all the headline number, but it's a long-term game theory thing. If there is some deportation of workers, well, because of supply and demand, if somebody's leaving a job, often you have to pay a higher wage to get somebody in there. So there are some things that I'd say is keeping inflation high, but the reduction in business regulations, the maybe expansion of energy production, those things are deflationary, but we think inflation is going to stick around more than 2%. A big theme that drove performance, as we said, is AI, Magnificent Seven. And it's not all about the Magnificent Seven. There's always secondary and tertiary stocks. So one stock we own in our core strategy is Adobe. I know most of you probably use Adobe Acrobat. Did you know there is AI within Adobe Acrobat where you can ask questions of a document? So we think there are many companies including Beacon beneath the surface. You probably know we use Salesforce, and Salesforce a lot of AI. So I kind of view the AI as akin to the internet, where it's a long-term productivity boost that is gradually going to spread to almost every industry. And all of our managers, we actually had a meeting today and talking about ideas and companies that can benefit from AI. Another one of our themes that permeates a lot of our strategies, both internal and external, are invest in high quality companies with above average profitability, free cash flow, and strong balance sheets. And we'll talk about some of the political, I guess, laws that might get passed. But one is that there might be a tax cut for domestic companies manufacturing domestically or doing business domestically. So a name like Grainger came up in one of our calls. They kind of provide parts and things to industrial companies. So there is a way that our ideas get into the portfolio. We obviously custom tailor them to each client. Our entire investment team is happy to meet with you one-on-one and explain these themes and further. But overall, let's recognize we've had a great 2 years. If we have more subdued returns and a little bit more volatility, we can handle that. But as long as there's no sign of recession, we're largely going to stick with our diversified portfolios. So with that, Brian and I'd be delighted to answer any questions you have. We know some have been submitted to the portal, and we'll get to whatever we can.
Thanks, John. Well, we did have a number of questions, and I think that in general, a lot of the questions and topics and things that continue to be on clients and investors' minds in general stem around the elections and the results and the change in administration and policy and outlook and so forth. So a lot of it, one topic in general, I'd like to just sort of address about how Beacon, in terms of our investment decisions, factors in the political considerations and investment options associated with that. And I'll just step back to, a webinar we conducted late last year ahead of the election saying, we don't technically want to have a major reaction in terms of asset allocation or investment ideas regarding potential policies, potential outcomes of the election, things like that, because we've had statistics in the past where election results do not have a major impact on financial market returns in the year following the election. It's generally even. So regardless of how you feel about the outcome of the election, it's the policies that we focus on. One of the things that John mentioned was in one of our, and I would say, incorrect was aggressive to say we were incorrect by saying that we'd have a divided government. I think one of the things that people should realize is that within the House of Representatives and the Senate, the majorities are so thin that, a lot of the campaign issues and policies, it's going to be very hard to get full majorities on every single vote. So I would consider with the seats the way they are today and the majorities as thin as they are, we do in some ways have a division of government that will keep policies in check to some extent. So that's why we don't make really big thematic decisions based on election results. We'd rather take the patient approach and let some of the policies start to come out. We're aggressive here in the first couple of days with headlines, obviously, and market reaction to some extent. But you'll see it, as John just mentioned. You'll see some of the subtleness of the changes within security selection or additions to certain asset classes where we are starting to see value. One of our big themes is broadening out in the participation of performance and taking a look at some of the advantages that some of the technological improvements and investments that have been made by the chip companies and the major technology companies that have driven performance start to bleed out more into different sectors of the economy as companies become more efficient and profitable and adopt the technology. Some of the themes, again, will resonate within industrials and financials, healthcare to a certain extent, energy, materials, things of that nature, where you haven't seen lots of performance opportunities, where we hope to see a lot broader of a participation, and not just in the large cap, but down the cap scale as well. So there's lots of dynamics, I think, that will create some value opportunities in the market, and again, we'll be reflecting that within security selection, asset class decisions, and so forth throughout the year. But more specifically, John, we had a few questions about the impact of tariffs and the inflationary impact, more specifically of full-blown tariffs out there, the ones that were being talked about on the campaign trail. Let's take 100% tariffs on China.
So at the margin, tariffs are inflationary. Let's just say that. So we have some case studies, all right? So from President Trump's first administration, you might remember there's a 20% tariff on washing machines. So you might say, what happened to washing machine prices? Well, on average, they went up 12%. So the producer is trying to pass some of the costs or most of the costs on. But let's also look back to the first administration. There were tariffs and inflation was somewhat under control. So I kind of view it as a long-term game theory. Are you placing a tariff to have a level playing field? Are you placing a tariff to have some national security interests? But, the basic game theory is if you place a tariff on me, I might place a tariff on you, and it kind of can spiral out of control. So how I would describe it is that if there are targeted tariffs, the economy could handle that. If there's a tariff war really around the world, double digits everywhere, well, that would be a lot harder for the market to handle. So, but in general, and this is one of our reasons why we think inflation is going to stay a little bit high, is that tariffs generally raise costs. Manufacturers try to pass on some of those costs, and that raises prices. So at the margin, we do think inflation is going to stay kind of sticky. And how we handle that is we invest in companies high quality that are able to raise prices, that have that pricing power. So yeah, I do think tariffs are inflationary, but we do have the first administration of President Trump where inflation didn't spiral out of control. So let's hope that's the case here.
Yeah, and I also think coming off of the ultra high inflation that we did see, we say that inflation is going to be sticking around at these levels, but as you pointed out earlier, well below, slightly below what's been the historic norm, but yeah, maybe shocking to people who sort of were used to very, very low levels of inflation. So as things tend to moderate, and again, you get a little bit of pressure from the shelter costs that you mentioned, as calculated in the consumer price index. If we see energy prices moderate throughout the year, that's a feedstock into a lot of different industries and could create that sort of cap on inflation as well. So again, it's a not a wait and completely wait and see attitude, but with the precedent that we've already seen, and the difference between a campaign and a actual governing attitude, we think we'll be in relatively good shape from an
Let me add
inflation standpoint.
one more thing. So President Trump, you might remember his first term, he said, if we're going to add a regulation, we're going to remove 2. And now he's talking about removing 10. Now, 10 might be stretching it, but removing some of these regulations does reduce the cost of business. And that is one way you don't have to pass on the full cost of the tariff. Maybe part of it can be passed on. And as I said, a lot of this could be a negotiating ploy where you get somebody at the bargaining table and then you don't put on the tariff. So we have a balanced view on it, but let's face it, we do think it is at the margin inflationary, and that's why we think inflation can stay over 2%.
Okay. Sticking on that, we have a question about just sort of reiterating our estimate for the yield curve, specifically 2-year and 5-year, the 2-year, 5-year part of the curve where we are sort of positioning portfolios.
Yeah, so as I said, we're expecting some modest cuts at the short end of the curve. Intermediate area, we expect it's going to sort of stay in this range. And part of the reason, you may have heard this kind of nickname, the bond vigilantes. So until we get this deficit under control, even though President Trump said today, I want interest rates to go down, the bond vigilantes are going to continue to keep yields kind of high. Sometimes we call this a crowding out effect, that if the US is borrowing trillions of dollars, well, yields have to rise to meet that demand. So I would just describe it as more of a trading range as opposed to a dramatic drop or surge. And the key thing driving that to me is what's going to happen with the deficit. The best way to handle deficit is you have growth and not really incur too many expenses. So that's what we hope for is the best case scenario.
Yeah, and just sort of an extension question that followed through about extending that out to the 10-year.
Once again, the 10 years viewed more as a longer term thing. So, I would probably say 4.5 to 5.25. That's probably my best estimate for it. And part of it is, as I said, we have these structural deficits. If there's, a way of reducing the deficit, which I think there are ways, let's see what gets through Congress, that would put the number back down. But just how we get to that number is you start with inflation, 3% plus, and then you have to add on some type of yield to get paid in excess of inflation. So one way to think about it is that if you think inflation is going down to 2%, which I don't think so, but if it's going down to 2, maybe the 10-year can go to 4. If you think inflation is going to stay around in this 2.5 to 3 or so range, then you get to that 5 range. So that's why I'm kind of in this 4.5 to 5.25 on the 10-year.
Yeah, and again, I think as things moderate and we get past some of the initial shock volatility within, the headlines post-election, post-inauguration and policy and so forth. That's sort of the range where we would believe that, the economy could be nice and balanced between a good growth rate, a good solid growth rate, continued profitability from companies, and not a general, restart or reignition of ultra high inflation. So I think that's, and again, housing market, if we talk about the 10-year, the mortgage rates are based technically off of the 10-year. And we've seen fits and starts. We've seen it's about 7-ish now for a 30-year conventional mortgage. And that's really got sort of a lock in the existing home market where we've had a bunch of refinancing activity over the years into, let's say, 3.25% long-term mortgages. But again, if we do stay in this range and we get sort of used to that and we get good economic growth, great employment situation, we could start to see some activity percolating in that sector of the economy. Here's a question that just comes in. What economic changes can help boost market performance from the range that we're looking at, the 8 to 12, to somewhat of a 15 to 25% range?
Well, let's talk about some positives. AI, right? AI, I think, can be a productivity boost. We know AI has some problems, but overall, we think it can help most companies reduce costs, be more productive. We're hoping for an end to the wars, right? So, there could be maybe instead of a black swan, white swan event. Imagine Russia and folks in the Middle East, they come into the world economy and sort of embrace what we're doing here. Let's say somehow President Trump meets with President Xi in China and they sort of get on the same page. So there is this geopolitical, let's call it peace dividend, that could boost things. I mean, it maybe not the whole base case, but it's certainly within the realm of possibility. And as I said, I think the market is sort of grappling with inflation, and as it kind of accustoms to that level, companies can plan better and hopefully improve profitability.
Yeah, I think that's a well-crafted response. And again, we wouldn't be opposed to generating returns of that nature. But again, the expectations are for, the sort of the settling in the more normalized type environment from a yield basis and also an equity return basis. I did want to make a bit of a comment because you did reference the last time we had 3 consecutive years of 20+% S&P type returns. In the period that you mentioned, I believe probably a lot of our clients and investors remember quite vividly was sort of that internet build out. And I just wanted to make the distinction because we talk about it all the time in terms of valuation. Back then, we had a whole lot of companies that were being formed and IPO'd and so forth that didn't really have businesses associated with it. We had ultra high valuations, and we had new valuation metrics like eyeball clicks and so forth. A lot of those companies don't exist anymore, which is why, again, I think it's different. Even though we do have a slightly elevated market cap valuation on the S&P 500 based on historical standards, those companies that have led the charge, let's say the Magnificent Seven, or a combination of 7 to 10, those companies are real businesses with a tremendous amount of cash flow, high intellect, and good, very strong, solid business models that we think can be sustainable. And even if they did to stay at the same multiple, they would still be big market participants in terms of performance. So big distinction in the types of businesses that are leading the charge versus the more speculative businesses that were apparent back in that time.
Yeah, let me just add to that, Brian. It's a great point. So I mentioned the Magnificent Seven names. We have three companies, NVIDIA, Microsoft, and Apple, that have a market cap greater than 3 trillion. Before the call, I asked AI, how many countries have a GDP greater than 3 trillion? It's only 7. So we own a lot of these Mag 7 names. We like them. I personally own some of them, but I think they might just grow at a more temperate rate because of kind of the law of large numbers. They can't become the size of the entire world, but they are high quality companies, tremendous balance sheets, and we just think it's either they slow down a little bit or the rest of the smaller companies catch up.
Yep. We have time for a couple more questions because now they're coming in. I guess the conversation leads to down different paths. Part of Trump's policies, obviously, on the campaign trail and early indications, he wants major tax cuts, and it's going to impact what we just referenced, the deficit levels, inflation. So what are the thoughts on portfolio impact if we don't get the associated growth?
Well, once again, I think you have to look at what companies can survive in a inflationary type environment. Companies with pricing power, companies that are global, companies that have a scalable business. And yes, I don't think we can afford these tax cuts. If you look at what President Trump says is going to pay for the tax cuts, tariffs, we talked about that, and also repealing of some subsidies. Clean energy is one of the things. So, when you're running a deficit, it says that interest rates are going to stay where they are or maybe tick up a little bit. Inflation is going to tick up, and you just need to go deal with companies that can survive in that environment. There is some, light at the end of the tunnel. Potentially being discussed as one way of reducing the Social Security deficit is investing a portion of the funds in the stock market, like an index fund, like Australia does. As you may know, Social Security funds are invested in U.S. Treasuries, which, as we discussed, are earning about 4%. Imagine if you have a 20-year or 100-year horizon and you can get 10% in that. So there's a lot of opportunities to cut costs, to be more intelligent, that could eventually reduce the deficit. But in the short run, I agree with our questioner or caller that these tax cuts probably can't be paid for with the tariffs as well as any repealing of spending on subsidies.
That is a concern, and it leads us. I think we probably have time for this last one, and I think it's actually a perfect way because we have painted a relatively good picture about our expectations for growth, our expectations for market returns, and so forth. We didn't really talk a little bit about how do we get there. We expect a lot more we expect some volatility as maybe a little bit above what we've had as we sort of weed through some of the again, policies that are put in place. So market volatility is always something that we pay attention to. But the comment was that our collective comments on balance suggest that we don't have many worries. So what does concern us? What concerns us? I'm glad we project that because I know we have concerns.
There's always something to worry about. So the most obvious thing is that what if there's a compression in the valuation multiple? So let's say there's less confidence, right? There's a lot of things to be concerned about. around the world, both geopolitically and with the economy. So one is that there's no magic number that the stock market has to trade at 20 plus times earnings. In fact, if you go back 100 years, it trades at 15 times earnings. Now we think it deserves a higher multiple. So that's the first thing, that just the valuation as a whole can be compressed. Two, we mentioned these wars that potentially is a peace dividend, but what if it goes the opposite direction, right? That could be concerning. We're already seeing some tension between President Trump and Jay Powell, who by charter is independent. So as I said before this call, I saw a headline, President Trump is demanding that interest rates go down. He can demand, but he can't really do anything about it. So, I can see a lot of that. We've seen President Trump potentially trying to acquire Greenland. So there's a lot of geopolitical things, and the market, we all follow the markets. The market tends to overreact in the short run, but in the long run, we follow the fundamentals and earnings and things of that nature. So there is always something to worry about, and we handle that through diversification. We also encourage our clients to have 1 or 2 years of their living expenses in some type of very safe asset, cash, money market securities, munis. And that kind of gives you the confidence to withstand the short-term volatility. Usually the main thing to worry about is there a potential recession? And we always are on the lookout. The forward-looking indicators, LEI, ISM are looking pretty good. And that, would maybe get us to have a more substantial change.
Yeah, and I think that's, again, consumer spending, consumer attitude, consumer accounts for, a little bit about 70% of our collective GDP growth. So that's why we look at some of those indicators that John mentioned, consumer confidence earlier in the presentation as being one of our themes as continuing to increase. We always evaluate the employment situation because that feeds right into your confidence to spend. If you're confident in your job or asset base, you're more confident to spend. So there are certainly plenty of things to worry about, but I'm glad that we do project a more calming a calming outlook. It's our job to worry, and it's our job to make hopefully decisions that add value into the portfolio and not sort of knee-jerk reactions to certain what we would perceive as going to be short-term events. So we're long-term investors. We like to construct portfolios that have longevity, that meet the goals and needs of our clients, and that cash liquidity component is a very, very important factor in that. So during the planning process, I hope clients are taking advantage of that sort of information to be a lot more comfortable with the longer term direction of the portfolios. So on that note, I would like to thank everyone for attending. I hope that we answered all the questions. There's a few in the queue, but I think that we're sort of out of time. That we have them, and we'll get back with answers for the respective questions. One thing I did want to mention that I failed to at the very beginning was that the presentation recording and the slide deck associated with it are going to be sent out to all attendees. So sometimes, if you're on your phone or computer, it may be hard to see. So those slides will be available to you. And feel free to reach out to your team or myself or John directly if any interpretation or further explanation would be needed on any of those topics. We love to communicate. So please continue to read our weekly recaps, our quarterlies, and attend our events like this. We think they're very informative, but we also appreciate your feedback if they're not, and how we can improve it, whether it's time, date, content, material, anything that's on your mind, we're open. So with that, I'd like to once again thank you for attending and enjoy the rest of your day.